to its capital markets to support the country's ageing society. Stella Lee finds out what it means for the pension industry.
China has one of the highest savings rates in the world. With inadequate social security support, many tuck away cash for old age. Ping An Insurance estimates that the per-person payout in developed nations is 100 times more than that of China. Currently, China's average pension reserve per person can only support the livelihood of just one urban resident for just a little over 2 months. Now, that's hardly a comfortable retirement, and hence, experts advocate that China's pension reserve needs to shift. To encourage pension contribution by taxpayers, they are calling for an investment-driven method which gives higher returns than basic savings contribution.
There is not, at the moment, mandatory participation either from employees or from employers. And so if you do it on a voluntary basis with no tax incentives, you're going to get very low take-up rates. So then we need a fundamental development to happen in the capital markets to provide the debt instruments, the long-term inflation-protected instruments to support the investment side of the pension system.
China's aging population has fueled the growth of its pension funds. The National Social Security Pension Fund is now the world's 10th biggest, and many expect it to leapfrog to the third largest globally within 3 years.
Each year, 10 million people in China become senior citizens. We need to adopt market measures to help the pension funds and offer services to attract private capital.
With China's staggering pension assets, financial liberalization could provide the outlets for investment. The funds could be invested in various asset classes beyond A shares. And in a sign that China is serious on pension reform, Premier Li Keqiang has highlighted pension services as a sunrise industry to drive economic restructuring. Stella Lee, CCTV News, Beijing.